All right. Well, thank you everyone who has gotten settled in. You guys will notice that this is another webinar, so we want to encourage discussion and questions. So if you do have that, please try to use the Q&A function at the bottom to submit questions. We'll probably try to answer the ones that are relevant when we can throughout the conversation, but then we'll save a few for the end as well. Big thank you to Pat and Jim and Wintrust again. I've known you guys for a few years now and gotten to sit through plenty of great information as far as the ESOP alternative and what that can mean for firms. I'll tell you, probably half the firms that I work with for executive search at Zweig Group are ESOPs. And it is quite the culture building tool. It's a great recruitment and retention building tool. And it's something that I think a lot of people are interested in finding more about. So I'll pass it off to you guys and we will take it away for the afternoon.
Sounds great. Thanks very much, Chad. Yeah, and thanks to everybody for setting aside some time this afternoon. We've had an opportunity to speak to some of you throughout the course of this conference. We feel like it's been just a great conference and really appreciate our partnership with Zweig Group as well. So really briefly, for those who haven't attended a session with us, Wintrust is about a $44 billion commercial bank. We were founded in 1991. Our founder, Ed Waymer, is still our CEO today, very entrepreneurial guy. Really built the commercial bank around various niche lending groups. One of those niche lending groups is the group that Jim and I really lead throughout the country, which is the ESOP Finance Group. And so this is all that Jim and I do is ESOP Finance. It's again, it's a national business for us, and we're unique in that we originate our own transactions, and that includes originating, underwriting, closing the transactions, and then also portfolioing those companies. So we manage those relationships. Actually, Jim is our national relationship manager for all ESOP Finance. So this is something that we're very passionate about. We're thankful that you are with us today to hopefully either learn something new about it, or if you already are ESOP, hopefully you get something out of this as well. So what I'll do right now is just hand it over to Jim. Jim, you want to start maybe, Chad, on slide 4, and Jim, you can get going.
Sounds great. Thanks, Pat, and thanks, everyone. I was starting at square one, really, just to start. What is an ESOP? An ESOP is an employee stock ownership plan. It's a qualified defined contribution plan. So what that means is there's a trust that gets set up that holds ownership in the company for the benefit of the employees that qualify to be a part of the program. So we very frequently see this as a key succession planning tool, but as Chad alluded to earlier, this has many benefits beyond just the succession planning. Most importantly, it's a great way to recruit, retain, reward, we like to call it the R's of the ESOP, but also keeps that autonomous entrepreneurial culture that many companies, especially in the AEC space, look to keep in place. A lot of folks say, why consider an ESOP? Beyond just looking at succession planning, there are some significant tax benefits that we'd like to get into and share, which very much benefit certainly the company and in some cases also the selling shareholder. So Chad, if you can move to slide 5. So to start, an ESOP must be, the sponsor company must be a corporation, so an S or a C corporation. So starting with the S corporations, recall S corporations, ownership is responsible for paying tax obligations. And a C Corp, the company itself, is responsible for tax obligations. So starting with an S Corp, as that ESOP, that ownership is a tax exempt employee benefit plan, that owner, and the ESOP, for clarification, is considered one owner. So it doesn't matter how many employees are within the company, it's considered one owner, which is that trust that's created to hold the ownership. that owner is tax exempt. So it's no longer that piece of ownership no longer is subject to federal taxes, and in many states, state taxes. So you can imagine 100% ESOP owned S corporation, when there's no longer a check being written Uncle Sam each year, you can realize just that pure benefit alone. If it's a partial S corporation, it's important to note that the ESOP still would be required to get its pro rata tax distribution that goes to the other owners. However, that cash can be used a lot of different ways within that ESOP to, as that cash does not need to go to Uncle Sam from there. So that it could be used for future repurchase obligations or for future allocations. So there's a lot of different ways to use that cash productively. But that S corporation ESOP ownership is no longer subject to most state and federal taxes. Shifting to C corporations, and we frequently see C corporations with a partial ESOP, and the reason for that is each year the company makes a tax deductible contribution to the ESOP, which reduces the taxable income of the company. And companies in this space that don't have much depreciable assets and other ways to reduce tax obligations in a non-cash manner, this could be really meaningful. That contribution is limited typically to 25% of eligible payroll. However, it's important to note that the C corporations can also make a tax deductible dividend to the ESOP, which can further reduce that taxable offset. If we want to go to slide 6, there are further benefits for the C corporation owners, and that is more for the sellers. So you may be familiar in the real estate world of the 1031 exchange, which is a like-kind exchange in the real estate world. There's something similar in the ESOP world called a 1042 rollover. And essentially that's a like-kind exchange for equity. So if the selling company is under, or the selling shareholder is a C corporation, that selling shareholder could have the ability to take the proceeds from the sale to the ESOP and roll that into a qualified replacement property asset, which is typically U.S. stocks, bonds, different bond offerings, and you can use that essentially to defer your capital gains tax. And that strategy is typically utilizes that at that selling shareholders passing, the basis steps up in this process, so that if at that point in time, if the qualified replacement property is liquidated, it effectively eliminated the capital gains tax. It's important to note in that context, we're talking capital gains. We're not talking any other taxes associated with the state and such things of that nature. So it could be a very powerful tool to get the liquidity event without having the big tax bill at the end. Also, for selling shareholders, if a C corporation is not something that's of interest, as an S corporation, there could be another bite at the apple for that selling shareholders. If they stay an employee of the company, as an S corporation, they do have the ability to participate in the ESOP. So start building some ESOP ownership, which could provide for a second liquidity event. Just a couple of qualifiers you'll see here as it relates to that 1042 for C corporations. The transaction has to be at least a 30% transaction to qualify. And the selling shareholder has to hold the stock for at least 3 years and not, acquire that stock via options or something of that nature. So a very powerful tool for both the selling shareholders as well as the company.
Hey, Jim, we got a couple of questions coming in here that I think might be relevant at this point for these last couple of slides. I figured I could just throw one in.
Sure.
So first question, what about the benefits that an ESOP misses out on, such as the 179D tax deductions and R&D tax credits? Isn't no tax better than deferred tax?
So are we talking about the S corporation structure? I mean, I would say, and usually what we see is, and for us not being CPAs, that would be an analysis that would have to take place. Many times, again, as a 100% S corporation, what we see is the no tax piece is really the driver for that. But I think that would be an analysis that would have to take place with either your CPA and or ESOP advisor to make sure that that tax offset is really meeting the objectives of the
And
company.
and Jim, those tax deductions, Chad, those tax deductions would be still available in a C Corp scenario. So, I mean, it does reduce taxable income for sure.
Okay. Well, Steve, I hope that helped answer your question from out there. And then we had a second one for S Corps that are under the PA agreement. Does that have to change when going to an ESOP? If so, any complications with that to look out for?
So what we do see is there is strategy, because we certainly understand that ownership many times has to be with someone that holds the license. So what we can do is there's different corporate structures that can take place. So there's a holding company that has the ESOP, and then the operating company still has that PA. So there are strategies in place to allow to stay qualified by having ownership as that PA while undergoing that ESOP transition.
Okay. Great, thank you.
And the only other thing I would add to Jim's slides is really, if you're an S Corp today and you feel like you would like to take advantage of 1042, you can convert to C Corp. So you don't, just because you're an S doesn't mean you only have S Corp available to you. You can switch. There are accounting regulations that prohibit you from immediately flipping back to an S. So there's typically a 5-year waiting period if you weren't an LLC going into it. But the idea is that you pretty much always do have both options available to you.
And it's a great point, Pat. I think many times as an LLC, depending on the tax treatment of that LLC, you can have the ability to maximize both by switching to C and then converting to S. So there are ways, but typically if you're a corporation today, you can switch to one or the other depending on what strategy you want to maximize. However, you do have that 5-year wait period to switch back. Thanks, Pat.
Yep. So Chad, maybe we could advance to slide 7.
And Chad, is there any other questions before we move on to this next slide?
There was one more. We can go ahead and knock it out. I think it might be an easier one for you guys. Is ESOP for all employees, or can it be structured for a selected number or group of employees?
Oh, it's a great question that comes up very frequently. So you cannot pick and choose necessarily which employees can participate in the ESOP. However, you do have to qualify to participate in the ESOP. And we generally say for those that qualification parameters are very similar to those that would qualify to participate in a 401k plan for a corporation. So based on number of hours worked, years of employment, and things of that nature. So once those qualifiers are in place, that would really determine who can participate in the ESOP.
Great. It is a good question, and it's a question we receive frequently.
Absolutely.
Yeah. So slide 7, if we're okay with moving on. So Jim touched on really, the financial, sort of the economics of the transaction. These next couple slides really dig a little bit deeper into the other side of this, which certainly does incorporate some of the economics, but really a perfect ESOP marries the economics with a little bit of benevolence from the selling shareholders. And we say that because certainly our economics behind this, but it's very infrequent where somebody who doesn't really want to give back to the employees that helped him or her build the business isn't a part of the decision. So we very frequently see that as a significant driver behind the decision, which is we believe an exceptional decision. So the first bullet point, we'll probably touch on most of these. The first bullet point is, I think really important because there's lots of reasons not to sell 100% at once. So what an ESOP does is it's a really, really flexible option. It allows you to do a partial transaction. And as Jim mentioned, with a C Corp, there has to be a minimum of 30% sale to incorporate the benefits to the selling shareholder. But other than that, as an S Corp, you can sell 1%, you can sell 3%, 100%, you can sell whatever you'd like. So there are really, really flexible options here. And a lot of that flexibility is really to help present ownership, diversify their assets. So the other piece of this, the next bullet point, an ESOP, really, you're kind of creating your own market for this. You do have a trustee, but you're pretty much creating your own market for the sale of your company. And the next bullet point, allows the selling shareholders to sort of ease out over time. Jim, in his first slide, touched on autonomy. In our presentation Monday, which was a lessons learned presentation, both Jeff Picard at the Vertex Companies and Jim Sussman at STG Design touched on autonomy as a real significant driver behind why they chose ESOP. Autonomy has nothing to do with economics. It has to do with, we've created what we consider to be a really great corporate structure, and we want that to continue. We want people to have the autonomy to run their businesses and their business units. And in the end, we think we'll get repaid. But I think it's really, really an important driver for most selling shareholders. The retaining of the upside, this is where, we continue to sort of marry in the economics behind this, but selling shareholders don't know anything better than they know their own business. So even selling some of their stock and retaining seller notes or retaining warrants, there's no return that they probably feel better about in their portfolio than their own business that they've really helped shape and build over many years. So this is a very significant driver of why ESOP is such a powerful option. And then, sort of the last 2 points we've touched on a lot. Jim and Chad both touched on and mentioned the 3 R's, which is kind of recruit, retain, and reward, and very, very significant pieces of ESOP. Having, going to campuses, trying to recruit engineers or design architects, and having an ESOP benefit plan versus not having an ESOP benefit plan may very well make the difference between, recruiting and really capturing great talent versus missing it. So it may be you've got great options on that front. Most businesses do, but it certainly helps in that recruiting process. And then the ownership culture is really, how do you say it any other way other than the employees are owners of the business? So really, really great reasons. And, what I think is oftentimes we miss and we don't touch on enough, Jim and myself, is, so say today you go ESOP, maybe even you sell 100%. So the ESOP has 100% ownership. Because you went ESOP doesn't prevent you from selling the company down the road to any other avenue. I mean, Jim and I, in our national portfolio, in 2020, we had 2 of our larger ESOP clients sell to, one sold to private equity, one sold to a strategic buyer. So these are, because you go ESOP, it doesn't prohibit you down the road from having any other sale option available to you. And in fact, both of those ESOPs were just hugely successful for the participants of the plan. So Chad, maybe if we could go to slide 8. So, and this, I'll touch on probably 4 or 5 points. So I'll start by saying Jim and I are really not salespeople. So most salespeople wouldn't have this slide in our practice. Our national practice is ESOP finance, but we oftentimes tell businesses that not maybe never, an ESOP is never the right option, but oftentimes we do say maybe not right now. And some of these would be some of the reasons why that might take place. So, and some of the challenging scenarios are really begin with management depth. Typically, what Jim and I see nationally is businesses, really successful businesses, come into a transaction, probably have had very little experience with borrowing money. And that's a good thing. That means the businesses have performed really well and they really haven't needed any support from any other institution. So when you're going to take on some leverage for a transaction, it's really important to make sure that your management team is prepared to manage the business with a little bit of leverage. And so we like to see good depth in management when we look to provide financing options to companies that go ESOP. The next two bullet points kind of go hand in hand. Really tough scenarios for us to place term debt are highly cyclical businesses and large customer concentrations. I say highly cyclical. We have a lot of engineering clients in our portfolio. We have a lot of contractors in our portfolio, but they're sort of what I would say conservatively structured debt structures, and because of the cyclicality in the businesses. And that's just something to keep an eye on. This is cash flow lending. This is not collateralized lending. So when we look to put financing structures in place, anytime we have really highly cyclical businesses that could dip and not really show the ability to service the debt that maybe we put on the books a couple of years ago, we just are very cautious with that, and we talk through that significantly on the front end with our borrowers. And the concentration is, if 75% of your business is with one client, it's a very difficult scenario also to place term debt on, because if that client happens to go away, again, this is not collateralized lending, this is cash flow lending, and if that client goes away, typically a significant amount of the performance goes away with it. So we just are very cautious in those scenarios. It's not to say we don't provide financing in those scenarios, but we talk through it significantly. The tight working capital, we really don't like businesses to go into a transaction with the idea that there's no working capital. And the reason for that is we really don't want businesses, historically, businesses have capitalized on opportunities, and we don't want, because we put some debt on the books, we don't want businesses to forego future opportunities because there's no working capital to really support that. So we pay a lot of attention to the working capital and the day one sort of working capital that can allow businesses to continue to capitalize on good opportunities. And then the last piece here is high growth businesses. High growth is, you might say, why not? What a great scenario. Well, high growth businesses eat up a lot of capital, and it's tough to reinvest in a business and plow all the money back into growth when you're attacking term debt that's been put on for a transaction. So again, it's not to say we don't do this, but we really try to put structures in place that are thoughtful, that can handle both scenarios. If it is a very high growth oriented business, our structures typically will speak to the need to continue to support that high growth.
Sure, and I'll interject here. There's a couple of questions that came in, and that last topic, I think we've got quite a few, hot firms that are out there on our list that are ESOPs that probably want to challenge you and say, hey, we're doing this, and there's a good way to do it, and it sounds like you guys can set that up. But what would the benefit be to a firm or barriers to selling to a company that's already an established ESOP? I think you touched on it a little bit, but it came in, and I want to go back to it.
Chad, I'm sorry. Could you ask that question again?
Sure. Are there any benefits or barriers to selling the company to an outside organization with an established ESOP?
No, actually, we see that as well. Oftentimes we see that because we see the acquiring company really likes the idea that the culture is there, and they like the understanding that the employees of the business really do have an ownership style already in place. So, and I would say, many of the engineering firms that we've taken, that we've sort of helped implement ESOPs, we feel like the engineering firms and a lot of the architecture firms have really widespread ownership to begin with. So we sort of feel like this industry already sort of does it. It may not have like strict ESOPs in place, but oftentimes what we see is multiple owners in the business, and already sort of an established ownership culture within the company.
Yeah, and I would just add to that, and if Jeff Picard, who was on our lessons learned discussion earlier this week, was joining us today, I think what he would say, and what he has said, I think during that discussion, is many times they're viewed as the acquirer of choice as an ESOP. And part of that, is Pat referenced, is culture. On the other side is, just that investment into the employees and kind of knowing the fate. A lot of times, many people understand the private equity model, which is not buy it and hold for a longer period of time. It's usually short to midterm investments. And then that private equity firm will look for a return and sell, the business in 3 to 7 years. As an ESOP, that future feels more certain to these employees, just given that this ESOP ownership structure exists.
Okay. We've got one more in the queue, but honestly, it's one that I think will be better that we save towards the end of the discussion, so we can have a little more time. So we'll hop back into the presentation.
Okay, great. So slide 9, Chad. These are sort of the flip side to the previous slide, which are some of the obstacles to ESOPs. These would be the really strong candidates, and what we see very frequently are high taxpayers. Companies that are high taxpayers, companies that really want to undertake a fractional sale. We do, believe it or not, we do see a fair amount of failed M&A sales, that maybe the business owner didn't fully understand ESOP on the front end, and then goes through the process of trying to sell the business, and in that process, it's sort of turned off by the PE or strategic process, and ends up moving down an ESOP path. So we do see a fair amount of that in our activity, but the majority of what we see are high taxpayers, fractional sales desired, and then also companies that have an acquisition mindset. And Jeff Picard at the Vertex companies would be a perfect example. They really knew they needed to build out some different disciplines, and the way they wanted to do that is, they wanted to, as Jim mentioned, be an acquirer of choice. So they've been very successful in their approach to the market, but certainly a very strong piece of why ESOPs are good candidates for business transition. The bottom bullet point, some of the characteristics, we're really, I've mentioned a couple times, we don't do really collateralized lending in this space. It's cash flow lending. So it's consistent and predictable earnings. And, it's typically, if not diverse, fairly diverse customer base. And then the other piece is really this idea of high free cash flow conversion. So some may or may not know what that means. High free cash flow conversion are business models that really don't have a lot of CapEx involved. So the pulls on the cash that's generated by the business are minimal. In a manufacturing concern where there's, the need to continue to build out locations and to bring in equipment to manufacture more efficiently, those are lower cash flow conversion businesses. And so that's not to say we don't do that, or that they're not good ESOP candidates, but when the majority of the cash that's being generated stays in the business, it's a very, very powerful for an ESOP.
I just had a few things I wanted to add to this slide. And I think that the biggest takeaway from this is flexibility, the flexibility that an ESOP provides. It allows for a succession plan that can really be done at one's own pace. So if it's one owner ready to start working through it, but not ready to exit that seat, that's something that this could certainly provide for by transitioning that ownership. And for a period of time, there would be zero impact really on that owner from their management seat. If there's a series of owners, and this provides an avenue to provide an exit for some or all. This doesn't have to be an all or nothing, as you may see with some other M&A opportunities that are out there. It really allows you to control your own destiny as you want. And to go back, Chad, you really made a good point earlier as it relates to the concept of high growth in ESOP. And if you see the last bullet point here, we talk about long-term acquirer, which really leads to growth. And so as we reference that, I just want to make sure that we're clear when we talk about doing an ESOP transaction and we talk high growth models, it really depends on how much leverage is put on that business to do this. If it's a bank like Wintrust that comes in and puts senior debt, those are payments on a regulated basis that, we want to make sure there's sufficient cash flow capacity to make those payments. And we're going to talk about a minute about the financing structures, but there's other ways to do it on a more patient basis with seller financing. And what you see is a newly established ESOP becomes a more mature ESOP, that leverage profile comes down and really becomes a big driver for that bullet point that we reference here, long-term acquirer. I can say long-term, our more mature ESOPs are significantly growing because they have the ability to do it inorganically, in addition to just having strong organic growth as well. So just a few clarifiers that I wanted to make sure we touched on.
Good deal. Well, a couple of other clarification questions came in, I think, from a couple slides ago. So is there a minimum number of employees you would recommend, or maybe just define the small employee base a little more clearly?
Yeah, so it would depend on S or C Corp. I would say there is no defined minimum. As an S corporation, there is what's called a 409P test. And what that calculates is concentrations within the owner, within the ESOP. And so typically we say, as a rule of thumb, if you have 30 or more employees, this will work, S or C. If you're below that, it had to be looked at more deeply, because the way it works, the concentration piece is also not just the number of employees, but ESOP shares are contributed to the employees based on compensation levels. So higher earners get more ownership within the ESOP than lower earners. So it also looks at payroll levels, things of that nature. That 409P test is not something that comes into play for C Corp ESOPs. However, from that tax calculation, that tax offset, if it's a small employee base, it's not going to be a very significant contribution number. So the tax offset is not going to be very significant. Hope that helps answer that question.
And I would say, from the C Corp perspective, Chad, like we have a client in the Atlanta area, it's an 11 employee C Corp. So it can be done. It's, as Jim mentioned, we and the professionals involved have to pay very close attention on the S Corp side to the 409P testing, but we do pay very close attention to it. So yes, there's sort of a little bit of a limit, but really not really if you want to get.
Okay. And, just hearing that specific case, another question that came in is, do you guys have experience structuring ESOPs for small, minority, or women-owned businesses?
It's actually a great question. So we've seen that, and it's been something that there's been, I'd say, varying opinions on how to keep those designations in place as an ESOP. So many times, if it's 100% transaction, we have seen that if there's a majority of participants within the ESOP that are female, you may be able to continue that. But many times, it does depend on the ownership and that end body that's making that designation. So a shift to ESOP ownership has potential to jeopardize some of those designations.
Okay. Let's see, we've got a couple more, but I think let's hop back in and make sure we cover some of this material and let a couple more questions pile up here.
Okay. Jim, you want to go to slide 11?
Yeah. And so this is really where Pat and I play. We get involved in the financing of the ESOP transactions. And it's important to understand how this works in the scope of a transaction, because the capital that's part of this is really the liquidity that is used for the selling shareholders in this process. So typically what we see in ESOP transactions are these 4 levels of debt. There's a commercial bank that can come in. That's where we play. It's usually lower interest rate. It's also not going to be the highest leverage. And that can be done in 2 different forms. Pat referenced before the asset-based or cash flow. What we do, we are cash flow lenders. We understand that our clients does not have the asset base, such as equipment or real estate, that we can apply a loan to value and get to that loan amount that's needed for the transaction. What we look at is sustainability of cash flow. And at that level, it's really looking at, is the cash flow going to be enough to repay this loan over the designated period? The most common form that inflow for liquidity to the selling shareholders is from commercial lenders such as Wintrust. If that amount from the bank is not sufficient enough to satisfy the purchase price, which frequently, if the ESOP is purchasing, I'd say 30% or more, typically we have to look at other forms of capital to get to whatever that purchase price or sale price is. So one form is bringing in mezzanine lenders. Mezzanine lenders typically bring in, we talk really in terms of EBITDA. So banks we're usually about 2 to 3 times EBITDA. Mezzanine lenders will bring in another turn to turn and a half of EBITDA of debt into a company. It's much more patient in the form of, it usually is interest only for a significant period of time, but it comes at a much higher cost. To put it in perspective, typically we're usually somewhere out of the gate in the 3 to 4% range interest paid on a bank loan from Wintrust. Mezzanine lenders are looking for returns typically somewhere in the teens, but for that cost, there's patience as far as the cash flows needed to repay that mezzanine lenders in the early years of that loan. We don't see mezzanine lenders very common, because what we do see is the selling shareholder is willing to take a seller note back for the difference between the price that the stock is valued at versus how much debt a bank like Wintrust can provide. And the reason is, who would rather have that return, rather pay it to a mezzanine lender or provide that return to the sellers? And most sellers view this investment as better than any other investment that they would make with that liquidity, because there's no business that they know better than the business at hand. So typically what we see is a combination of bank debt and seller paper to really bridge the purchase price for this ESOP transaction. We don't want to leave out equity, although we don't see it very often. It's very infrequent that the employees are asked to contribute capital for this ESOP plan being established. If they do contribute capital, it's typically via rolling over 401k proceeds. And if that's the case, those shares get allocated immediately, which could create potential challenges down the road for the repurchase obligations. And repurchase obligations are the cash that's needed to buy back those shares that are allocated to employees, either at retirement, or they hit a certain age where they can diversify and put the shares back, or they pass, or they're let go. So, we just want to make sure that, there's plenty of capital there to support that over time. So we don't want to gloss over that, but it's something that we don't see very frequently, and it's a very regulated and costly process to utilize, but it is something that's available in the capital structure. If we want to move to slide 12, it's a really nice visual as it relates to the capital structure, a lot of which is what we just talked about. But it's nice to see, you know, just kind of how these fall into play from cost and risk and expected return. So where Wintrust fits is really that very top with the revolver and term loan. Again, very low cost debt, also very low risk to the lender. As you move down, that risk profile gets higher and it becomes more costly debt. So as you see, you know, the mezzanine and seller notes, that's typically in the junior section, and that will come, you know, at a little bit, I'd say more than a little bit higher cost, but does come with elevated risk. Usually that is interest only. And so holding that note for a period of time without having a repayment does get higher return to that lender or higher cost to the company. Last is equity. You know, we view seller debt as equity-like, given the subordinated nature of that. So, you know, again, similar concept. That will come at a higher cost to the company, a higher return to that selling shareholder. So a nice visual. Not all of these tiers of capital typically come into play in the ESOP transactions, although, you know, these are all options available from the capital markets perspective. Chad, are there any questions at all on the financing markets?
There is. What would specifically cause someone to consider 2 to 3 times EBITDA when you can get 4 to 7 on the market?
So I think it's important to note that 4 to 7 multiple is usually, we're talking valuation multiples now, not debt multiples. And I would say that 4 to 7 multiple on the valuation side still absolutely applies to the ESOP. You know, I'd say generally, you know, what an ESOP has to purchase the company at fair market value. There is a negotiation that takes place. So although there is a valuation that takes place, that value does get negotiated. And I think, you know, if you were to look at some of those, the deltas between the valuation of an ESOP and others, I don't think the gap is as wide as some may believe. Now, I would preface that by saying the ESOP can only pay fair market value. And that gets determined via that negotiation evaluation process. And a private equity firm or strategic buyer, you know, they can pay a premium to fair market value if they view synergistic things or other items that they feel that they can get that return. So it does depend on those scenarios. But a 4 to 7 times multiple in the AEC space, in the ESOP world, is something we see all the time.
And I would add to that the 4 to 7 times multiple, and this gets back into, you know, the earlier slide where ESOP isn't really right for everybody. The selling shareholder that wants 4 to 7 times liquidity, it's really, ESOP's probably not the right option. And I say liquidity sort of like day one liquidity. So you want to sell your business and then day one, you don't want to be owed anything. That's probably the scenario for private equity or a strategic buyer. That's really not the avenue for an ESOP. Typically, ESOP owners, selling shareholders are getting all of their money repaid to them over, you know, I would say on the very short end, 5 years, and probably on the long end, 10 years. So the time horizon is very different. And so the question from the audience on that front is, you know, sort of the question back is, what's your desire? Do you want to be out today, or are you okay with staying in? If you're okay with staying in for a longer period to sort of transition the business, then an ESOP may be the right avenue. If you're really interested in being out today because, you know, you just want the dollars that you've built up over your lifetime, which you're totally entitled to, then ESOP's probably not the right avenue. I hope that helps, Chad.
You know, I think it does, and maybe we'll add to it a little bit more. Can retiring partners and associates sell back their stock to new partners and associates, and thus get a retirement sum of some sort, or are they under some new obligations?
So I think that question is in the form of if there's a partial ESOP, let's say 30% ESOP, and the rest of the business is owned by the management team. As they retire, they don't have to sell to the ESOP. That is an option, and depending on how the buy-sell agreements are in place, but it doesn't necessarily require that those stock that stock gets sold directly to the ESOP unless it's set up that way. So there's plenty of flexibility in regards to that.
Okay. So would anyone in particular need to personally guarantee the ESOP loan from the lender, you guys?
So at Wintrust, I will tell you this, and I'll just use this example because it's probably the most common one we see is if a business owner or owners is selling all of their stock to 100% ESOP, it's very hard for philosophically to then ask them to guarantee that debt. So in our practice, it's very rare that we have personal guarantees. I would say if in the case of a partial ESOP, and if there needs to be credit enhancement and there is majority ownership, that would probably be where personal guarantees do come into play. But our practice is really driven by sustainable cash flows, we referenced many times already, and really understanding that the goal here is succession and divesting that ownership group from the company over a period of time. As Pat referenced earlier, it's usually not immediate. There needs to be some patience on that end, but it is something that we very rarely in our debt structures ask for personal recourse.
Great. Well, so we're getting a lot of specific questions about the size of the firms that are really, primed for this type of investment. So, does Wintrust or any similar banks, are they willing to work with firms as maybe as small as 5 people with under $1 million cash flow?
So I'll start, Pat. Maybe you can add some additional color. So I'm gonna address the question really in size of EBITDA, and I hope everyone is familiar with the term EBITDA. It's earnings before interest, taxes, depreciation, and amortization. So we're really looking at the earnings of a company beyond either debt payment, the debt interest or non-cash items and taxes. So when we look at that, I would say when you're looking at getting liquidity from the transaction via senior debt, where we play, it's really hard for companies of EBITDA less than, I'd say $1.5 million or $2 million. It becomes challenging to do an ESOP and put bank leverage on to help provide liquidity to the selling shareholders. When you think about just the front end cost to implement the ESOP and go through that process, it is in the M&A space. So there is multiple sets of counsel. There's a trustee, there's a valuation firm, there's bank counsel. When you start thinking of those front end costs, which I'd say on the low end could be a couple $100,000, we've seen on the high end, and again, I'm talking much larger transactions, it could hit high 6, it might even approach 7 figures, but that's very few and far. So I'm not saying that's the norm either. But even let's just say the cost is $250,000, and you look at an EBITDA, you got to look for a return on that cost as well. So we typically say, and where we typically play is with companies with EBITDA between 2 million and 10 million is where we typically play. We've been involved with EBITDAs, and we're looking at one that's 30 million. So it doesn't mean it's not something we look at. But once you get below that 2 million or 1.5 million, taking on debt makes it challenging. That being said, the last thing I'll say and hand it over to Pat is, the other alternative to do it is, entirely seller financed. So, that will take a patient seller that's willing to get the liquidity from the transaction over a longer period of time and really not getting that cash flow, day one.
So I would just add, we consider ourselves, when Jim says 2 to 10 million of EBITDA is where we typically play, we consider ourselves sort of small cap to mid cap ESOP finance, an ESOP finance institution. But we like those businesses a lot. We spend a lot of time in that space. But to make sense of the cost, as Jim mentioned, associated with the M&A transaction, oftentimes it doesn't make sense for very small companies to really go down the ESOP route. But a couple of statistics for people that are interested in the size of ESOP. So there's roughly 7,000 plans throughout the country. Maybe like 13 or 14 million employees throughout the country are members of an ESOP. 99% of the plans So the top 80 plans are public companies, which house the majority of the plan assets. But when you get beneath those 80 public companies within the ESOP space, 99% are 58% are employees less than 100 employees. And then 41% are 100 plus employees. So just to give you a snapshot of where this plays out, the 100th largest ESOP in the country is a company with about 1,000 employees. So, I mean, it's not the idea that it's only for large companies is absolutely a myth. It is a misconception. So, but on the flip side of that, 5 employees might be difficult to make sense economics wise once you factor in how much expense is associated with actually executing the transaction. But 58% of all ESOPs are plans with less than 100 employees. So, I mean, it's a huge, huge number. So I hope that helps frame the size of companies and where ESOPs play in the space.
I think it does really well. And just to let everybody know in attendance, I checked with with Olivia, and she said we can go long here. So if we've got any extra questions and we need to go over this hour mark, as long as Pat and Jim are good to hang around, we can continue to do that on my end.
And Chad, the next section was really just common questions. So this is great. Let's keep it going.
Okay.
Yeah.
Well, let's bust into these common questions, and we'll let a couple more fill up in the queue and then knock them out. Okay, so slide 14, will a business owner get a lower exit value? Jim sort of touched on that. This is so private equity and strategics can pay whatever they want for a business. An ESOP cannot, given the trustee is acting on the best interest of the employees and is really capped at fair market value. That's all the ESOP can pay. But what has to be done in this process is there has to be a real tax adjusted analysis has to be done to sort of marry the two, and compare the two. So oftentimes what we see is on the surface, it looks like PE or a strategic buyer might be paying more and it might be better for the selling shareholder. But when you factor in the tax nuances and the tax benefits available to both the selling shareholder and the surviving company, oftentimes that evens out real quickly. So I would just say, Jim, I don't know if you have anything to add to that, but
yeah, the only thing I would add is if you have a chance to talk with someone who's gone through the ESOP process, many times they do run a dual path. And I think what many are surprised to see is that ESOP alternative in the process, that delta between a third party, whether it's a strategic or private equity versus the ESOP, is either non-existent or not nearly the gap that they originally thought, and made the ESOP really a no-brainer at that stage. So, I would just say, in the succession planning process, when you only have a handful of options available to you, it's doing yourself a disservice to either not get educated or not run out almost every alternative out there. I mean, if I had 5 cars to drive that I could purchase, I would test drive them all. And I think what many find out when they really run out the ESOP alternative, especially when looking at valuation, that delta is not nearly what what people go into it expecting it to be.
Yeah, and as an organization, like we don't try to stuff an ESOP on a company. We don't. We just like to educate, and we believe that our clients and everybody who's going through a business transition process should be fully educated on every option. And we, very clearly tell the folks you should run it all out. And as an organization, we have a very, very significant sponsor finance group. So we lend. We have significant national relationships with very active private equity firms, and so we do a lot of all of this kind of financing. So we're not we're not trying to pigeonhole people into, businesses into one alternative versus the other. We really think it makes a lot of sense to understand all of the options. So this,
Chad, if we want to just go to some additional questions, I feel like many of the questions that have come through are really what we have outlined. Does that make sense, or would you?
Sure. And a couple of them we're in line with really what's going on the screen right now. So I think we definitely covered is this only for large companies? That's a myth. But one specifically that we could tie to this third bullet point is what determines the timeline for sellers to get fully bought out when selling to the ESOP.
Yeah, that's a tough one. It's really driven by a number of things. How many opportunities to reinvest in the business are available over a time frame where the business is clearly still running. So I think selling shareholders and management teams have to make a decision. Do they really want to attack the seller debt, or do they want to continue to grow the business? So there's no perfect answer to this question. But what we typically see is that selling shareholders, when you factor all of these, different sort of pulls on cash throughout a business cycle, it typically takes 5 to 10 years for a selling shareholder to be out in full from the debt that they're owed.
And that would be in an 100% transaction. And so many times what we do on the front end is model that out for our clients so they can get a picture and really have the right expectations as to when that full liquidity event is going to take place. We're working on one right now. It's a 30% ESOP transaction. So it's going to be entirely funded via debt from Wintrust. So there will not be a seller note in that case. I would just add, as you look through that process, the 5 to 7 years, our term loans are typically 5-year term loans. Occasionally we go to 7 years. We very rarely get to the maturity of the bank's debt before we go back to the company and say, are you ready to take out more seller debt? So in that process, we're constantly reducing that seller loan. Our mindset, our goal is to get the liquidity to the selling shareholder that's earned it. And so I'd say on the fastest end, it's usually 5 years in the case of a 100% transaction. On the longer end, it could be 10 years. So there is some patience needed from that selling shareholder to get the liquidity. But really, we talked about all the benefits that come along with that patience earlier.
And I'll give you a real live scenario. So let's say a company is 100% S Corp ESOP. They have a great acquisition opportunity in front of them, yet the selling shareholder is owed significant dollars. So they come to us and they say, well, we'd like to get repaid a little bit on our seller debt, but we have this great acquisition opportunity in front of us. So sort of, we analyze that and say it's really difficult to do both right now, like day one today. But if you had your druthers, where would you want to go? Do you think this is such a great opportunity for the business that you can't pass it up? If that's the case, maybe we defer paying some of your seller debt until next year. And so those are the kinds of decisions that we talk through with our clients. And oftentimes, I would say the majority of the time, that is the scenario. An acquisition is the scenario. And the business owner sees the acquisition as such a crucial piece of the growth that, many times the selling shareholder says, yeah, I'll wait to get repaid. I think this is the right thing for the business and we need to move on it.
And I would just add to that, because it's important to understand, as a selling shareholder may say, why would I be patient when I have the seller note? What does the benefit of the acquisition do for me as that seller? And I would say many times in most of the structures of the seller notes that we see, there are warrants attached to that seller note. A warrant is like, consider it a stock option, another bite at the apple for that selling shareholder. It's really the ability to get upside in future performance. So, a common question is, why would I consider, going through this transaction today? As I look out over the 3 to 5 year horizon, I think my company's here and it's going to be here. So why would I do it today when I think I can get more value there? And one of the, considerations there is to say, well, you can sell the business today if the value and everything else, liquidity makes sense to you, but you can still capture the upside of when that performance gets here via this warrant vehicle. So we can spend a lot more time on that. But, I just think it's important to understand that that seller's mindset is not just about you typically in an ESOP transaction about liquidity and that time frame. It is a factor, certainly, but also how to really find a way to have that warrant value maximized for that second bite at the apple.
Sure. And so we've got a few more questions coming in if we still got some time here, but I want to be respectful. You guys good to hang around or to answer any more?
We are, yes.
Okay, let's try to knock out one of the less loaded questions up here. Can you suggest a document that would describe some case studies of successful ESOPs in the A&E world?
Yeah, I would say there's two associations, there's more than two, but the main two associations for ESOPs are the ESOP Association and the NCEO, which stands for National Center of Employee Ownership. Both of them conduct significant studies. Some are industry specific, but there's great data there. And they've been doing a lot as of late, looking at data of ESOP owned companies during the current times versus non-ESOP. So I would say if you just look up those two associations, the NCEO seems to be more driven by providing some of that data, but certainly the ESOP Association also does. There is some great data, and if you'd like, you can reach out to either of us and we can share some additional data that we have.
Okay, great. So in this case, we're asking, is there a firm, or if a firm is wholly owned by another company, not an individual, is an ESOP viable? And I think I work with a client like this, so I'm interested to hear this answer here.
Pat, do you want to run with it?
So yes, so if a company is owned by another company, is it eligible for employee ownership? Are you talking like a subsidiary, like a company that's a subsidiary of another company?
Let's see.
I guess I'm not real clear on.
I would think it would have to be.
I guess in that scenario, the answer is really no. I mean, unless the company is sold off, and then certainly the company can go through the process of running down a path of employee ownership. But it can't be
100%. You can't do 100% transaction. Yeah. But in the case of any ownership, if the parent company wants to own 70%, 50%, an ESOP can own that difference. I'd say it's not common, but I do think a partial ESOP, if that parent company wants to retain ownership, is something that can be done.
Yeah, it would have to be, the partial ownership would have to be at the parent company though.
Sure, and I believe that's the scenario that I'm familiar with too.
Yeah.
So that person said yes. I do believe you've answered his question correctly.
Okay.
Let's see. How does the company traditionally fund redemptions from retiring employees? Are there required minimum distributions for retiring employees?
Yeah, Pat, I'll give it a stab. So repurchase obligations, that's what we're referring to. That's a big component of our space. It's something that we need to, we spend a lot of time managing, especially as an ESOP matures. It's not really something in the first 5, maybe even 10 years of a new ESOP, mainly because there's not many shares allocated during that time frame. There's vesting periods, and frankly, the share price in those early years is at a lower level. As time goes on, so typically how it works is there's a threshold that's set, usually $5,000, and if that falls, if the repurchase obligation for that individual falls below that, it's usually a one-time settlement. Once it gets above that threshold that's set, the company has a few options. Typically, they have the ability to defer that payment for 5 years and then pay it out over 5 years to really spread out that cash flow needed to satisfy this requirement. But it's important to note over that time that individual putting those shares back to the company does get the benefit of the share price appreciation during those years. So a lot of firms we work with, if they are in the position where their cash flow can't support payments more in a lump sum format, they don't like providing share appreciation to employees that aren't contributing to that share appreciation. but there is that built-in tool to provide flexibility to these companies to make sure that they can sufficiently manage their cash flows. And the last thing I would add on that is it's a significant focus of ours is repurchase obligation studies that are done usually on an every 3-year basis, which is really a forward-looking actuarial study that provides, looks at, retirees and things of that nature, expected share price, so we can have an idea and start planning ahead as to what the future potential pulls on cash could be for this repurchase obligation.
Yeah, and I would just add, so one of the, maybe if there's a downfall to an ESOP, it's here, because you sort of become a victim of your own success. And so the more successful you are, the higher the repurchase obligation is, because the higher the stock value is. So Jim and I pay very close attention to this issue with our clients, because it can be a significant pull on cash. And there are real strategies for managing this. Jim said, we're very active in the space. We don't do the studies ourselves. We have third parties that we work with do the studies. But the idea behind really understanding this is there are different ramifications for either redeeming the stock at the company level or recycling the stock at the trust level. And the different scenarios really need to be thoroughly understood so that you can really manage the share balance issue, which sometimes, it can become an issue of sort of the haves and the have-nots within the ESOP. And so we pay very close attention to managing that and helping companies understand how the different strategies will impact both the number of shares outstanding, available for allocation, and the value.
Great. No, I think that's a perfect explanation for that. So we've got one or two more questions here. This one we might, you guys might want to pull out your crystal ball for, see if we can try to understand as everyone starts to plan for 2021 and what that brings. So under a new Biden administration next year, where tax rates are likely to increase or change, is an ESOP transaction benefited by increasing tax rates or not?
Pat, do you want to address this one?
We just think there's such, bipartisan agreement on ESOPs. It's hard. You could play both scenarios here. And rather than get into a whole lot of detail on this, I would say we don't anticipate, even in a transition of the current administration, we don't see that in 2021 it's going to be an issue. We think it'll take probably a period of time before any tax implications get fed into the system. But I would say overall, the ESOP concept is extremely widely agreed as one of the true bipartisan agreements within the political stage.
I think it will maximize, or we'll start seeing more 1042s. As capital gains rates go up, the ability to defer those capital gains, we might see that as something picking up. But I totally agree. I think it's something that employee ownership is something that's really been embraced by both sides of the aisle. Great.
Good to hear. So one last follow-up question that I kind of saved for last, because I think it's a tough one, but I figured out a good angle on how to ask it to you guys. So a lot of people out there believe the 3 R's that we talked about earlier, and how this can be such a great cultural tool for firms to employ. But a lot of managers report that employees aren't necessarily motivated by it. Are there any techniques that you've seen working with firms that really help promote that culture of an ESOP throughout the firm?
It all comes down to communication. If you go to these conferences within these ESOP associations that I earlier outlined, there's tracks dedicated to communication. It's really hard, especially in the early years of an ESOP. Most folks don't realize what a great benefit it is. And where we've seen the most successful communication strategies is showing these success stories, going to these examples, finding these mature ESOPs that may have gone through an event or not. I have it in my family. Father-in-law retired last year, was been with an ESOP since its beginning. It's an enormous benefit he got that he wouldn't have had if he wasn't part of an ESOP. And it's not in lieu of anything that was taken away from him. It was just given to him just by working hard. And so what we've seen, the best ESOPs have a communication strategy that really tie and show, and the employees embrace the fact that they can control an element of their compensation via the share price going up, driven by performance of the company, and seeing peers and, you know, other firms, and really just showing how great of a benefit is. But in my opinion, it's all communication based and making sure the employees understand what a great benefit it is. And it really can be the X factor for many companies. And I would say, you know, talk to other ESOP companies and either learn from ways that they weren't able to maximize it, or learn from those that have. And those that have, you know, you could just see within their company just the difference of being an ESOP.
I do think I take a little bit of a different position on this than Jim. Just maybe my age is a little different, but we agree on. I completely agree on the communication. But I think the question is a really valid question, and it can't necessarily be 100% addressed with communication. So the reality is that the engineering architecture space is typically a more professionalized space. And so your employees maybe are maybe just in this grand scheme of things, a little more highly educated, and so probably capable of grasping some of the nuances behind ESOPs better than some other companies' employee bases that we serve. But there is a real issue with this question, and it is a real issue. How do you really keep people? And, you know, we talk with our clients all day long about, you know, some of the millennials in our group, and I say millennials, it could be anything, don't necessarily see it as a huge benefit. They might, as time sort of moves on, but today we're having a hard time. You know, we hear a lot, we're having a hard time getting through to really, you know, drive this idea that today's savings, sort of today's benefit, equals tomorrow's, you know, really significant benefit for you. And so, you know, the only way we know is the way Jim suggests, which is to communicate and to try to really drive home that this is an exceptional employee benefit. But at the same time, we recognize the question is a very valid question, and it's a very difficult question to answer. If you don't do the communication, it definitely doesn't work. So the communication definitely does drive this and make people more aware, but it is a challenging issue for sure.
And you do have the ability within the ESOP to provide financial motivation to key members of the management team beyond just participation in the ESOP. There are management incentive plans or stock appreciation rights, different awards that you can selectively provide to key members of management for motivation and you know, rewarding those key employees within the ESOP. So you still have those options available to you as well. But totally get it. You know, it's becoming a more and more common issue, which is why we're seeing our industry spend more and more time on the communication to try to find ways to help with this issue.
Great. Well, I think that pretty much wraps up the questions that came in the Q&A, and I tried to grab the ones out of the chat. So thank you again. What great audience participation we had today. There was a lot of praise in the chat as well. So anybody who wants to follow up, maybe continue the conversation a little further with Jim and Pat, we've got their information up on the screen right here. But if you are interested, and I know a lot of you already are because you've already emailed Olivia, we will get you this presentation and then put you guys directly in touch with them to continue some of this good banter. A lot of great questions today, and I know now why this is such a popular subject amongst most of the firms that we work with.
Great. Chad, thank you so much. Olivia, thanks so much. Thanks to the Zweig group. We really enjoyed the entire conference. So, and thanks to everybody for joining us today.
Yeah. We will.
Have a great day, everyone.
We won't see you next time, as this will be one of the last sessions. But like everybody said, it's been a great conference so far, and we'll have something special to follow up with everybody later.
Great. Thanks again.
Thanks, everybody.